I'm going to share the simple strategy that got me profitable. I'll break down the basics of this strategy, I'll show you some examples from today, and then I'll tell you how you can watch me trade this strategy live every day. Let's jump straight on the charts. This strategy combines three basic pieces of technical analysis. The first being trend, and I'm talking about basic uptrend or basic downtrend identification. What I like to see is consecutive higher highs and higher lows without any breaks of recent lows. On a downtrend, we're looking for the same thing in reverse. Very simple here. It helps if you can identify a trend that's consistent on multiple time frames. So you'll see when I give you an example from today, we lined up the trend on the 1 hour with the 15 and then down to our trading time frame, the 1 and the 5 minute. The second piece of this strategy, the very, very basic technical analysis we're going to use, is support and resistance. You've heard about it before. I'll explain how I use it and how I identify it. We're going to identify a prior high in an uptrend that price breaks and then pulls back to look for an entry. I don't believe support and resistance has massive predictive power. I use it to structure risk. So in this instance here, we see price pushed up, pulled back down, broke this high, indicates a continuation of this uptrend, pulls back down. When price gets to this level here, our second piece is to identify this support and resistance level, and then we're going to look for price action, the third piece. Price action to show us some indication that this move is likely to continue up. A lot of times as price pulls back, it'll do so with a lot of momentum, large bearish bars down into the zone. We might want to wait for price to start to stall, move sideways, consolidate, and then push back up. On a lower time frame, we would look for something along the lines of price to come back down here, pause, maybe start to create small amounts of higher highs and higher lows out of the zone. Then we would look for an entry. What we don't want to do is just, as price is blasting down to the zone, enter. It's a lower probability if you're placing trades that way that it'll work out. You'll get a lot of trades that just blast down, the trend is over, or it's going to pull back a whole lot further before continuing up. So if we utilize basic price action, I'm not talking about a specific candle or a specific pattern, I'm talking about basic structure, we can increase the likelihood of this trade playing out favorably. So when it comes down to the zone, I'm going to give you the basics of this. Again, it's a discretionary strategy, which means it's not going to have objective levels or rules, concrete rules that I'm going to use for an entry. It's based on context and intuition that's developed through experience. Having a strategy like this will help you to develop that intuition and that experience. So as it comes down here, price pulls back. Let's say it starts to push up a little bit higher. We see favorable price action. We're going to look to structure the trade in a way that makes sense. We're going to want to place a stop somewhere below a prior low. Basic stuff here. Very simple. How far below the low? It depends on structure, depends on what the trend looks like, what price action looks like. But somewhere at a point where it's below a low or a prior low where we say, if price comes all the way down here, we no longer think this idea is going to work out. We think it's much more likely that price will continue down rather than continue up. If it's anywhere above that point where we think, okay, if price comes all the way down here, it's still likely to continue up, the stop loss shouldn't be there. It should be at a point that makes sense where you want to get out of that trade. And for a target, we're going to base it off of a prior level of structure. So maybe price came down like this. It reacted off of a zone a couple times and then started to push down, and now it's breaking back up. We might say this level right here, past this prior high, is a zone that we want to target. Maybe we see price action up here that looks favorable, but we're going to base our target off of some prior level of structure. We're going to start with a 1-to-1 risk to reward. I know, crazy, right? 1-to-1. And how we're going to make sure we end up with winners that are larger than losers, or we're going to actively manage this trade. What do I mean by that? As we enter and price continues, we're going to watch to see if price action forms favorable structure in the direction of our trade. If it does, we'll look to add a second position, a third position, and so on, and reduce reduce risk on initial positions by moving the stop loss up in a space that makes sense. If price starts to move against us, we're going to look to close early. Mind-blowing stuff here, guys. We're going to cut our losers short and we're going to add to our winners. It's all the axioms you've heard. And guess what? I trade full-time. This basic discretionary stuff is what's worked better than every indicator, every candlestick, every chart pattern. This allows the flexibility to do what makes sense, objectively reading price action, have a less than stellar win rate, somewhere around 50%, and ensure my winners are just a little bit bigger than my losers. I do that by cutting my losers short when I see prices moving against me. It's showing momentum down past that zone. I cut it short, hopefully before the stop loss, or at worst, it gets stopped out. It happens often. I end up with about a 50% win rate. Over a long series of trades, a large enough number of trades, this is going to average out to about a 50% win rate. When it moves in my favor, as price pushes up, creates new highs, forms upward structure, I look to add to these trades. I stack on positions and I capitalize on these winners. Now that you have the really advanced concepts in this strategy, let me break down how this played out on an actual trade I took today. So we are on USD JPY. I'm starting on the 1 hour here to display how the trend lined up on multiple time frames that was favorable for this trade. As you can see here, it's in an uptrend. That's about the amount of technical analysis I'm going to do to determine that. I see consecutive higher highs, higher lows, higher highs, higher lows, higher highs. We're in a bit of a consolidation area here with price chopping back and forth, but overall, I would call this an uptrend on the 1 hour. I find myself mostly entering and managing trades on the 1 minute with this strategy, but again, you can use this on the daily, you can use this on the 4 hour, whatever time frame you see fit. I believe time frames are fractal. They act very, very similarly outside of the extremes like the 10-second chart or the monthly chart. Support and resistance is going to work the same. Trends are going to work the same, and price action is going to work the same. It's going to play out a lot faster on the 1 minute than it is on the daily, and there's some other nuances to trading on lower time frames versus higher time frames, like spreads and leverage playing a much larger role. News is going to push through a whole lot more on lower time frames, but I won't go into any more detail than that in this video. So we went ahead, we dropped down to the 15-minute. We see this uptrend structure. It did pull back down here. And now we see price starting to form, start another uptrend. I'm not drawing a trend line here, but what I'm looking at is, okay, price came down, formed a low, pushed up, pulled back down, pushed up to break these highs over here, pulled back down, pushed up again. And now I'm anticipating maybe that this trend upwards is going to continue and it's going to push through on lower time frames. We saw a pullback here, and now I believe we're likely to see this continue up and form a new high. So we're going to drop down to, let's get to the let's get to the 1 minute. So I'd like to see, and what I wanted to see today, because this is an actual trade I took today, I wanted to see price come up and break these highs right here. I wanted to see that because that would tell me that price is starting to push up and form bullish structure on this lower time frame. I want to see, again, consecutive higher highs and higher lows. I don't want to see price come all the way back down here. I don't want to see it pull up here and then push back down. That just shows that this pullback on the larger time frame is continuing. So let's get rid of this stuff and we'll push this thing forward. I'll draw my first zone here just as the area that I'm watching this to break above to start to look for entries. Okay, starts to push up. Okay, we get a break above. Let's see if price continues. I can't remember exactly where I entered this thing, but I'm gonna do this in replay mode, knowing that we took a couple buys on this, and I'll lay it out for you here. So it pulled back and pushed up. Pulled back. This was going to be the entry. So after price pushed up past this level, I'm looking for buys. What I want to see is support and resistance continue. As you can see here, it played out very nicely. Price pushed up, broke this high, pulled back down to the area of this prior high, and then pushed up. I want to see something similar occur here. When I'm actually going to enter is when price action is giving me a reason to believe that it's likely to continue up from this level. I'm not entering as it's blasting down into the zone. I'm entering on some form of bullish price action. Again, not a specific pattern, not specific candlesticks, but something that's going to show me that this is likely to continue upward, or at least momentum has slowed coming into this zone, and it's a favorable risk structure for me to get in. So let's play this forward and see what we get. Okay, that's the first bullish candlestick. And then we get another one. Here's my entry. Simple as that. Price came down, hit this area here, and I'm going to look to enter anywhere around here once price starts to turn around. I like to start with a fairly wide stop to begin with. It allows me to get out if price does come down before my stop loss. If it starts to just push right back down, shows me I'm wrong. It gives me the room to get out. And it also allows me to add consecutive positions and then drag this stop loss up. I call it active trade management. You can call this scaling into positions when we're talking about adding positions. You can call it stacking positions, multiple names for it. We're going to add to our winners. Simple as that. As we're placing this entry, so we got a 1-to-1. We decided on 10 pips. It's below this low here by a decent amount. If price pushed back down here past this low, I'd say, you know what? It's a fake out. Maybe it just came up here. Took these highs out. Now it's going to continue down. We're going to get out. We're going to look for something else. So we've got a 1-to-1 structure. Now we're going to look to the left and we're going to identify an area of structure that we see that makes sense to set a target. So we want it to be above our 1-to-1. That's the first step. If it's all this structure down here and we're not able to generate even a 1-to-1 risk to reward, we're not going to take this trade. So we're going to go ahead and look left. And I like this area here. I see a lot of tops. I'll even include this, this high over here. Let's go ahead and get back over to our trade. Again, I'll speak on the discretionary, subjective piece of this. This is not a rules-based strategy. Most of what you will see taught on YouTube by other mentors are rules-based strategies. They haven't worked for me in the past. And what differentiates me and my program is the discretionary subjective style that I teach. I believe having the flexibility to read price action and add to winners and cut losers short and develop the intuition and experience doing that has helped me get profitable. And I believe it's what will help others get profitable. I believe there's a lot of different things that work for different people, but I believe black and white rules-based systems, they don't typically work. If they did work, most of them would be coded into EAs and everybody would be kicking back on the beach making a ton of money. If you are trading a black and white rules-based system and you are applying any amount of subjectivity and you say, well, it can't be coded into an EA because sometimes when price looks this way or structure forms this way, I don't take that trade. You're applying your subjective opinion on that specific trade, and as a whole, that strategy is not a rules-based strategy. It's discretionary. You're applying your discretion to it. Again, nothing wrong with that, but I think it's important to make that differentiation between the two. So again, what I teach, what I show, how I trade, it's discretionary. It's based on intuition that I've developed over a long period of time watching this stuff play out over and over and over again on the charts. That's what I believe has helped me, and that's what I believe will help others. So again, when I'm identifying where I'm going to enter, where I'm going to get out, how I'm managing these trades, I'm using my intuition, I'm using my experience. You might say, well, how the hell do I do that? By getting experience trading a discretionary system. And what I provide as a coach for this is watching me trade live, trading alongside of me live, allowing people to work through their own thought process and develop their own intuition and their mindset behind taking these trades. Let's jump on this one. I'll show you how this played out. I'll show you how I managed it, and we can get a feel for how this worked in this situation. We get our entry here. We start with a 1-to-1. We're going to play this forward. If price comes up, this is all context based, but typically how I will add to positions is if price comes up and breaks this, I have an option to add as it's breaking, or I can wait for price to push up and then pull back to this new level of support that we're going to identify right now, find an entry here, and then push up. Entering as you're breaking this prior high will ensure you catch the move, because there's times where price just rips up and does not pull back. There's plenty of times where I won't get an entry based on this, this style of trading. The downside with it is you have a much worse risk to reward structure. Your entry is going to be up somewhere up here as price is breaking, and your stop loss is going to be closer. If you wait for somewhat of a pullback and then a push up, oftentimes you get a better entry at a lower point, and you get your stop loss placement a little bit better. Downsides of waiting: the move may be over. It may not be pulling back to push back up, so you might be getting in on price as it's coming back down, and you may never get the pullback. We're going to watch price. It consolidates a bit, starts to push up, boom, it breaks above this high. Let's say we go ahead and enter here. We're going to clone this position, and we're going to stack on another one right here. We're going to make sure the stop loss is below this low. I move this one up, and now we've taken on one full unit of risk, and we've got 0.62 units of risk open on this. Let's play this forward. Pulls all the way back down, takes out that low. Glad we didn't have a stop too tight. Comes down, gets close to our stop loss. Consolidates, and then pushes up. We can wait for price to pull back down here, or we can enter as it broke above. On this one, I would have been entering somewhere right here. Let's go ahead and wait to see if we get a pullback. We'll add another position if we do, and we'll manage from there. Price pulls back a bit there, not all the way down to our zone. Pushes up, makes a higher high. This position has already reached a 1-to-1. This position has already reached a 1-to-1. I don't think I got another entry here. I don't know if I would take one this far up in the move. Let's see if we get the TP hit. We do. So this position was initially a 1-to-1. It ended up being around a 2-to-1. And this one ended up being around a 1.65 to 1. What we can see is price pushed up, we entered again, we moved stops up. As it broke this high and formed this structure here, we can bring these stops all the way up here below this low, or near break even for both of them. We ended up with a nice win simply by identifying trend, utilizing support and resistance, basic support and resistance, and price action. When I'm talking about price action, I'm not talking about wild candlestick or chart patterns. I'm talking about structure forming, bullish price action coming up out of a zone that says, hey, it's not blasting down through. We got a couple bars moving up. Let's go ahead and get an entry here. If it had turned against me at this zone, what I would have done is cut this thing short. If price came down here, instead of pushing up, we entered here, it pushed up and broke, we added. If price came down and then continued past this low, I likely would have exited before the final stop loss. In a worst case scenario, again, it blasts down to the stop loss. It happens. With this strategy, I end up with around a 50% win rate. We get nice consecutive wins. We get consecutive losses. That's how it happens. This level of technical analysis, and any level of technical analysis, in my opinion, does not have this massive predictive power that gets you these 80 and 90% win rates. This will end up being around a 50% win rate. How this is wildly profitable is the winners are capitalized on. I'm adding positions on. In this trade, had I been buying at the breaks of highs, we would have gotten a third position in here. So again, a very, very basic approach. No indicators, no crazy concepts, nothing that is really clouding our judgment. We're looking at raw price action. We're looking at structure. We're identifying a trend. We're identifying a support and resistance area just to structure risk. And then we're getting into the market with a nice stop and a nice target, reasonable target, in an area that makes sense. And we're going to look to add on winners, or we're going to look to cut these things short if they start to move against us, which happens, again, about half the time. If you went to the chart and you entered randomly less swaps and commissions and fees, you would end up with a 50% win rate. And you would end up break even, which is much better than most traders. Most are losing. If you look at any broker's website, 70, 80%, it depends on where you look, are losing money. They're required to post those numbers. So just random chance with a 1-to-1 is better than most traders. If you add in adding to your winners while controlling risk and cutting your losers short, trying to get out before one full unit of risk or at maximum that one full unit of risk, you're doing better than most and you have a profitable system. You get to learn this through experience, by trading this, by back testing it, by live trading it. This system is tradable by anyone. We're not doing anything groundbreaking here. This is stuff you've heard. This is the simple stuff. This is what works for me. If you want to learn more about that, check the link in the description and in my bio to the free Telegram where I post analysis, I post trades. And then if you want more individualized help, that's what my coaching programs are based on. One-on-one help, one-on-one interactions with me, or group setting interactions with me. No paid course, no paid videos. That's the stuff I'm going to put out here for free. If you made it this long, feel free to subscribe, feel free to like. If not, I wish you the best of luck either way. Thanks for watching. Make sure you read the full disclaimer in the description of this video. I'm not a financial advisor. None of this is financial advice. Trading is extremely risky. Most traders lose money. You're probably going to lose money. You shouldn't listen to anything I say or take any of this seriously. It's just for entertainment purposes only.